3 weeks. That's how long a widow in Ohio had before her property tax bill jumped by $2,200. Not because she did anything wrong, not because her home suddenly became a mansion, because one form, due on one date, sat unsigned on her kitchen counter. Right now, somewhere in your mailbox or your inbox, there's a letter that looks exactly like junk mail. It isn't. Is your name on a list that determines whether you pay the real tax bill or the inflated one? By the end of this video, you'll know exactly which forms protect you, which deadlines are already closing, and how to make sure August doesn't become the month your budget breaks. Welcome to OG John Hub, where we break down what is really happening with your money. Her name was Carol, 68 years old, retired schoolteacher, living in the same house outside Columbus since 1994. She bought it for $71,000. 30 years of slow, steady appreciation later, the county assessor valued it at $280,000. That number alone didn't scare her. What scared her, what she didn't even know to be scared of, was a single line on a form she'd filed every year without thinking twice. This year, the form changed. The county updated its senior exemption renewal process, folded it into a new online portal, and mailed a notice that looked, frankly, like every other piece of government mail she'd learned to set aside for later. Later came in August. The exemption was gone. The full market rate applied. Her bill nearly doubled. Here's the part that should make you uncomfortable. She did everything right for 29 years. It only took missing one cycle to lose it. So why does this happen to careful people? People who pay their bills on time, who don't carry debt, who consider themselves financially responsible? The answer sits in how local government funding actually works. Most people assume the federal government controls their financial calendar. It doesn't want, not for this. The federal fiscal year starts in October, but nearly every county assessor, every school district, every state Medicaid office runs on a fiscal year that starts July 1st. That date is when local governments lock in their revenue numbers for the next 12 months. And to hit those numbers, counties need accurate property valuations finalized before summer ends. Sit with that for a second. The exemptions that protect seniors from these valuations were written decades ago, most in the late 70s and early 80s, when home values moved slowly and a missed form cost maybe $40. Actually, let me put that differently. It wasn't just cheaper back then. The entire risk profile of missing a deadline was different. Today, a starter home from 1990 can be worth 4 times its original price. The tax rate hasn't changed much. The valuation underneath it has exploded. That means the penalty for the exact same mistake, one missed form, has grown from a rounding error into a bill that can eat 2 or 3 months of a fixed Social Security check. Here's what almost nobody explains clearly. These senior exemptions are never automatic. Not in Illinois, not in Texas, not in Florida, not anywhere. The law places the entire burden on you to reapply, re-verify, and resubmit, usually every single year, usually in the same narrow window between May and July. According to public records from multiple county assessor offices, these renewal requirements exist specifically because the exemption was designed as a conditional privilege, not a permanent right. If you don't ask for it again, the county isn't required to remind you. They're required to remove it. If this is the kind of honest, clear breakdown you've been looking for, hit that like button right now and subscribe to OG John Hub. Every week, we bring you exactly this, and share this video with one person in your life who needs to hear it. Now here's where it gets worse before it gets better. Say the tax bill catches you off guard, like it did Carol. The instinct is to pull money fast, sell some stock, take an early withdrawal from a traditional IRA, whatever covers the gap. That single decision can quietly trigger a second problem months later. Any withdrawal from a traditional IRA counts as taxable income the same year you take it. If that extra income pushes your modified adjusted gross income over a specific federal threshold, it can affect your eligibility for Medicare savings programs the following year. One emergency withdrawal to fix an August tax bill can result in a Medicare premium increase that shows up the following spring, completely unrelated on the surface, completely connected underneath. That's not a typo. One form, filed late, can touch your property tax, your income tax, and your healthcare costs, all from a single missed deadline. Think about that for a second. The system isn't designed with malice, but it isn't designed with mercy either. It processes paperwork. It enforces dates. It does not call to check if you're okay. There's a real lesson hiding inside Carol's story, and it's simply this: protection in this system is never permanent. It's renewable, and renewal is your responsibility every single year. Nobody at the county office is tracking your case personally. You are the only consistent safeguard your own finances have. There's a second lesson, too. Small forms carry large consequences precisely because the dollar amounts underneath them have grown so much larger than when the rules were written. A form that used to protect $40 now protects thousands. Treat it accordingly. A third lesson worth sitting with: emergency decisions made under financial pressure often create a second delayed problem. Pulling from a retirement account to solve today's crisis can quietly set up tomorrow's. Before you withdraw anything to cover a surprise bill, it's worth understanding exactly how that withdrawal will be taxed and what else it might touch. And the last lesson is maybe the simplest. The local area agency on aging in your county has state health insurance assistance counselors who review these exact documents for free. They don't sell anything. They just know the forms better than most of us ever will. Using that resource isn't admitting defeat. It's exactly what a careful person does. So back to that letter sitting in your mailbox, the one that looks like junk mail. Is it protecting you, or is it the notice that quietly removes your protection if you never open it? Carol's mistake wasn't carelessness. It was trust in a system that doesn't send reminders. The good news is this: the fix takes 15 minutes and costs nothing. Finding your county assessor's exemption form, checking the renewal deadline, confirming your name is still on the list. That's the whole task. Drop your state in the comments so we know exactly where these deadlines are hitting people hardest this year. And remember, everything discussed here is for education and discussion only. This is not personal financial advice. Your money, your decisions, your responsibility. See you in the next one.